Do you know that every financial statement prepared by a business is built from information stored in the general ledger? Whether a company is a small local business or a large multinational corporation, the general ledger serves as the central storage location for a company's financial information. Now, in prior videos, we analyzed business transactions using the accounting equation and T accounts, and then recorded those transactions in the general journal. Now we're ready to move to the next step in the accounting cycle, posting journal entries to the general ledger. In this video, we'll discuss the purpose and structure of the general ledger and learn how accountants transfer or post information from the general journal into the individual ledger accounts step by step within a manual accounting system. Posting the general journal entries to the general ledger is step 3 of the 9-step accounting cycle and represents the point of no return. Once the journal entry is posted, you cannot delete it. You can reverse it with another journal entry, but you cannot delete it. That is why we've invested quite some time into the analysis of the business transactions and determining the correct debit and credit for the transaction. The general ledger consists of the general journals we recorded, but instead of the journals' chronological order, the general ledger is organized by account number. Think of it like a filing cabinet with individual slots for each account. The process of posting is automated in most companies, but you need to understand what the system is doing and be able to test that everything functions as it should during system implementations. Typically, the accounting team is responsible for end-to-end system testing when system modifications are being implemented. So it may seem tedious, but this is what you need to know because you will likely be involved in system upgrades and testing. And after manually posting to the general ledger, you will have a good sense of appreciation for the automatic posting capabilities of an accounting system. The process of manually posting a journal entry to the general ledger consists of these 5 steps. On the ledger form for each account, we'll enter the date of the transaction and enter a description that describes the entry. We'll enter the journal page in the posting reference column, which allows anyone to review who reviews the general ledger account to find the entire journal entry on the general journal page. We next enter the debit amount in the debit column or the credit amount in the credit column, depending on what is written in the general journal. And then we'll compute the balance and enter it into the debit balance column if the balance is a debit, or the credit balance column if the balance is a credit. Then you'll go back to the general journal and enter the ledger account number in the posting reference column to show that the general journal was posted. Now that you know these 5 steps, let's practice this concept with the help of, you probably guessed it, Eli's Consulting Services from our textbook. Here's the first transaction for Eli's Consulting, where Trade and Eli deposited $100,000 into the company's business bank account on November 6th. In the general journal entry, we recorded this business transaction by debiting cash and crediting Trade and Eli Capital for $100,000. The general journal records transactions in chronological order in which the transactions occur, but now we want to have a permanent record of the transaction by account. That process is called posting to the general ledger. And we start the posting process by pulling up the account patch, and we start with step 1 of the posting process by writing the date into the date column. Step 2 of the posting process is to enter a description. Our textbook does not list a description, but in practice, the journal entries have a description, like, for instance, in this case, investment by owner. Step 3 of the posting process requires us to write the page number on which the general journal was written into the posting reference column of the cash account. In practice, you would likely have a specific journal ID number that you reuse each month for recurring journal entries, meaning those that are recorded each month, or a specific code that identifies manual non-recurring journal entries. In this case, though, we're using the journal page number, and we write J1 in the space to present journal page 1. In step 4, we write the debit of $100,000 into the debit column, and in step 5, we calculate the balance for the account. This was the first transaction for Eli's Consulting. Therefore, there's no prior balance for the bank account, and we write the balance of $100,000 into the debit balance column. For step 6 of our posting process, we enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. The account number for the cash account is 101, and we write that number into the posting reference space. This tells anyone reviewing the general journal that the entry has been posted. Now, in a computerized accounting system, the general journal would have the word posted in the status column, but we're not finished yet. We still need to manually post the second line of our entry. We pull up the general ledger account for Trade and Eli Capital and follow the same steps. We start with step 1 of the posting process by writing the date of the transaction in the date column. Step 2 of the posting process is to enter a description, and as a reminder, in practice, there should be a description, but our textbook did not include one. Step 3 of the posting process requires us to write the page number on which the general journal was recorded into the posting reference column of the capital account, and we write J1 in the space to represent journal page 1. In step 4, we write the credit of $100,000 into the credit column, and in step 5, we'll calculate the balance in the account. This was the first transaction for Eli's Consulting, therefore there is no prior balance for Trade and Eli's Capital account, and we write the balance of $100,000 into the credit balance column. For step 6 of our posting process, we enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. The account number for Trade and Eli Capital is 301, and we write that number into the post reference space. This tells anyone reviewing the general journal that the entry has been posted, and we have now completed the posting of our first general journal to the general ledger. We'll now look at the second transaction for Eli's Consulting, where Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. In the general journal entry, we recorded this transaction by debiting equipment and crediting cash for $5,000. Now, we first find the account 141 for equipment. And as part of step 1, we enter the date of November 7th into the date column. We don't have a description for step 2. We'll move on to step 3, where we enter the posting reference J1 into the post reference column. And in step 4, we enter the debit of $5,000 into the debit column and calculate the balance of $5,000 as part of step 5. As part of step 6, we write the account number 141 into the first line of the journal entry to show that this line was posted. But we're not finished yet. We still need to manually post the second line of our entry. We pull up the general ledger account for the cash account 101 and follow the same posting steps for this account, except that this account already has activity listed from November 6th. To post the November 7th transaction, we start with step 1 of the posting process by writing November 7th into the date column. Step 2 of the posting process is to enter a description. As a reminder, in practice, there should be a description, but our textbook did not include one. Step 3 of the posting process requires us to write the page number on which the general journal was recorded into the posting reference column of the cash account, and we write J1 in the space to represent journal page 1. In step 4, we write the credit of $5,000 into the credit column, and in step 5, we will calculate the balance of the account, which had $100,000 after the first transaction, and we now calculate the new balance of $95,000. As part of step 6, we write the account number 101 into the second line of the journal entry to show that this line was posted. And that completes the process of posting the second journal entry for Eli's Consulting. We continue with this process until all 12 journal entries have been posted, and we can look at Eli's Consulting General Ledger. Here's account number 101, cash, and it shows us 10 cash-related transactions, the running balance, meaning the balance after each transaction, and the ending bank balance of $111,350. There's actually quite a bit of information we can learn from just looking at the general ledger account for the cash account. We can see that we increased the balance with 3 transactions, one from the owner for $100,000 and 2 from customers. Eli's Consulting issued 7 payments, 4 in November and 3 in December. Now, on a regular basis, the accountant should compare the general ledger activity and balance for the bank cash account to the online bank balance to ensure that there aren't any transactions that have not yet been recorded, like bank fees, interest, and return checks. At least monthly, the accountant prepares a bank reconciliation that officially confirms that all bank transactions were recorded in the general ledger, and the only differences between the general ledger balance and the official bank balance are due to timing, like checks were issued but haven't yet been cashed by the bank. Next, in the accounts receivable general ledger account 111, we can see that Eli's Consulting had credit sales of $11,000, but that currently clients owe Eli's Consulting $5,000. In a computerized accounting system, accountants will be able to view a report called Accounts Receivable Aging report that shows the balance in this account by customers so that you know if there are problem customers that should perhaps not be allowed to receive more services on credit. Now, I've added in a sample AR aging report that you have an idea of what it looks like. The aging report has the name of the company, followed by the report title and the date of the report. It then lists the customers that have outstanding invoices, their payment terms, the invoice and due date, and the amount of the invoice, and a listing of invoices for Eli's Consulting businesses that are not yet paid by customers for a total of $5,000. That's important. The AR aging report should be the same amount as the general ledger report for the accounts receivable account. What this report is telling us that of the $5,000, over half are past due, meaning customers were supposed to have paid, but they didn't. And it also means that the accountant may have to call the customer or send an email to ask for payment for past due invoices. Now, in addition, the customer may also be placed on credit hold, meaning all additional services are only given if payment is received immediately. In a manual accounting environment, the accountant prepares the accounts receivable subsidiary ledger to see what customers have what open balances and to keep track of customer invoices and payments. You'll learn more about that in Chapter 7 of our textbook. The general ledger account 121 for supplies shows a balance of $1,500. The prepaid rent account 137 shows $8,000, and the equipment account 141 has a balance of $11,000. The General Ledger account 202 for accounts payable shows that Eli's Consulting still owes $3,500 to a vendor. And just like we looked at an aging report for the accounts receivable, companies typically use an aging report for the accounts payable as well, or the account prepares an accounts payable subsidiary ledger. More on that in Chapter 8 of our textbook. This type of report shows all the open invoices that must be paid in the next week, month, or quarter, and it helps to identify quickly if invoices are past due. It also helps with cash planning because the accountant can see how much money is needed to pay the outstanding invoices. We also have the two owners' equity general ledger accounts here, account 301 for Trade and Eli Capital, and account 302 for Trade and Eli Drawing. And our last three general ledger accounts are for account 401, fees income, with two transactions for a total of $47,000, and two expense accounts, account 511, salaries expense for $8,000, and utilities expense number 514 for $650. Accounts typically work with a significantly larger number of general ledger accounts. There are often hundreds of general ledger accounts and sometimes even more than that. And at times that can be overwhelming. However, there's a certain order to how the accounts are organized and numbered. The balance sheet accounts appear first and are followed by the income statement accounts. The typical order is assets, liabilities, owner's equity, revenue, and expense accounts. For merchandising companies, there's also a section for cost of goods sold. This arrangement speeds the preparation of the trial balance and the financial statements, and many companies follow this methodology. In addition, there is a chart of accounts, a listing of all accounts, and their account number that you can reference. In Chapter 4 of College Accounting, you learned how accountants record transactions in the General Journal and then post these transactions to the General Ledger. Together, these steps create the foundation for accounting records that ultimately support the preparation of financial statements. Now, while technology has automated some aspects of the accounting process, accountants still need to understand what happens behind the scenes to ensure that financial information is complete, accurate, and reliable. As you continue your accounting studies and career, this knowledge will be valuable not only when recording transactions, but also in auditing and reviewing financial information, troubleshooting accounting issues, participating in system implementations, and testing new accounting software. These concepts are among the most important building blocks of accounting, and we'll continue to build on them throughout the remainder of this course.